Awesome. So thank you everyone for attending today. Today we will be doing a webinar based on invest like an institution, how to diversify your portfolio with private equity, featuring Jacob Schulman. Before we get started, however, I just have a quick disclosure that I need to go through. The views expressed by speakers of the CAMA webinars are those of the speakers only and may not reflect those of CAMA, its members, or employees. CAMA does not guarantee the accuracy of information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented. CAMA absolutely does not endorse or recommend any individual or organization, including the speakers. CAMA, its members, and employees do not accept liability for losses and/or damages arising from errors or omissions within, reliance upon, or any use of the information provided by the speakers. Individuals are strongly encouraged by CAMA to conduct their own due diligence before making any investment choices. CAMA does not act as nor offer the services of an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expertise is required, the services of a competent professional should be sought. With that said, I am not William Mucker. I am Michael Duncan. I host our Road to Financial Freedom podcast. Will is out sick today. He typically hosts these, but there's his information. If you have any interest in contacting CamaPlan about starting an account, he's the guy to contact. His information is on screen right now. But with that being said, Jake, if you're ready to go, I am ready to pass it over to you.
I'm ready to go. Thanks so much, Michael.
Of course.
And good morning or good afternoon to everyone. Thank you very much for tuning in. As background, my name is Jacob Schulman. I am the Director of Investor Relations at Oak Hill Capital. And Oak Hill, for those that don't know, is one of the oldest private equity firms in North America. We are focused on the North American middle market. The firm started as a family office in the 1980s, and after a lot of success investing the family's wealth, the firm decided to raise institutional capital in the late 90s and created Oak Hill Capital. Now, 20 plus years later, we are currently investing out of our sixth flagship fund. And about me, so I've been at Oak Hill for 5 years now, and my primary responsibilities are marketing our firm's products to prospective new investors, as well as servicing our current client base. We have over 100 institutional investors in our funds and over 200 individual investors in family offices. So needless to say, there's no shortage of work for me to do on a daily basis. But one of my goals over the last year is to try and expand access to funds like ours to individuals. And big reason why I started to decide to partner with CamaPlan and do this podcast. Speaking to my friends and family, even many don't know much about the asset class, and even if they do, they are unsure on how to even invest with firms or where to begin. So today, I'm going to talk about why one should invest in private equity, how to choose a manager that's right for you, and provide some global insights into what investors are focused on today. So just give me 1 second. I'm going to share my screen. I have a couple of slides prepared. And hopefully everyone can see that. So maybe we'll begin with why one should invest in private equity. So a traditional 60-40 allocation to equities and bonds may no longer be enough to meet one's long-term investment goals. Alternatives can help lower volatility, enhance returns, and broaden diversification of a portfolio. There are also various long-term megatrends that are driving the evolution of alternatives, and adding these to your portfolio may help it withstand shifts in secular trends. The factors that drive returns in public markets may have little or no impact in private equity, enhancing PE's diversification potential. The private ownership enables long-term strategic focus as opposed to the public market focus on quarterly earnings. This patient perspective has the potential to generate significant return on investment. And as a whole, private equity has exhibited attractive performance on both a risk-adjusted and on an absolute basis. So I mentioned lower volatility. So over a very long period of time, PE has shown low volatility and returns uncorrelated with the broader market. As this chart shows, the volatility of performance of PE is almost half of that of the S&P and lower than the 10-year treasury. The same data also shows a negative correlation between annual private equity IRRs and the S&P, supporting alleged diversification benefits of the asset class. For those in or nearing retirement or looking for income, private equity provides a low volatility source of income, similar to dividend investing, which allows investors to replace or supplement their earned income or retirement income. Now, this is a survey conducted by one big research firm called Preqin. It just shows what, it's a survey showing why institutional investors invest in private equity. And one of the biggest reasons behind that is diversification. So as mentioned, alternative investments typically have a low correlation to more traditional asset classes. Alternative assets therefore provide an opportunity for portfolio diversification, reducing overall risk exposure across investments. Many alternative assets are also a hedge against inflation. Many investors have discovered that alternatives are a way to protect against volatility, diversifying their portfolios. This way, when the stock market drops significantly, they have a hedge of protection and not all of their investment portfolio will be affected. And as many of you know, myself included, the stock market is famously unpredictable, even in a stable economy. And alternatives are largely shielded from unpredictable swings in public markets. For context, just putting numbers so everyone can kind of grasp what, just how much one should invest in the portfolio. The average institutional investor, meaning a public pension fund, an asset manager, or a bank, they have around a 10% allocation to PE. That means 10% of the portfolio is allocated to private equity investments. Endowments, the endowment model, given its long-term nature, they're between 20 and 40%. And individuals and high net worth investors are anywhere between 0 and 20%, most commonly 10 to 20% if you have a very well built out portfolio. So investors have been drawn to the potential returns offered by PE throughout history. Now, obviously with the caveat, some disclaimer, while returns cannot be guaranteed, alternative assets have the potential to offer much higher returns than their traditional counterparts. One big caveat that many are turned off by private equity is the capital's tied up for much longer periods of times. However, and very relevant given this podcast and who I'm speaking to, I don't think this should be a really big concern investing out of a retirement account such as an IRA. In essence, an IRA is the perfect type of account to invest in the asset class given the long-term nature. Now, as this chart shows, private investment funds have outperformed public equities, particularly over the medium and longer time periods, due in part to asset selection, fund manager capabilities, and portfolio diversification. Even in down markets, private investments have provided either positive or relatively higher returns vis-a-vis public market investments. During some of the worst performing periods over the past 24 years, returns were up 3% for private equity, while the performance of the public equivalents were negative. Now, I don't have a lot to really say on the slide. The picture kind of speaks for itself, but over the longer term, private equity has remained one of the highest returning asset class in private markets. And for those that are looking to what type of investment I should bring into my portfolio, I have some VC investments. I know I have a good exposure to equities and bonds. This is a very nice chart to show the upper end of the range and the lower end of the range in terms of where private equity fits in that return distribution. Pretty much one of the highest returning asset classes, but also the downside, the bottom quartile return managers are still way above some of the other asset classes. Now, on the institutional side, many see it as the real prize in private equity is the potential for outperformance above the median. The top quartile cutoff for the 2007 to 2017 vintage period, for instance, is a net IRR of 21%. In private equity, some firms significantly outperform the rest of the pack. Additionally, the risk of underperformance has been lower over this period, with bottom quartile PE funds returning well above their other private market asset classes. So how are firms doing this? How do our private equity firms generate this outperformance? Now, every private equity firm likely has, or those that are good managers likely has what we call at my firm, at least, a playbook, their strategy in terms of how they go about approaching investing and creating value in this market. This slide is obviously a representative example in terms of what we do at Oak Hill, but overall, private equity is able to generate these outperformance through the reason behind it is for longer term investment for horizons. Private funds pursue significant growth initiatives to maximize equity value, and sometimes it takes a long period of time. That might not be achievable under the shorter term focus of public market shareholders. There are substantial information advantages, allowing for more robust investment analysis. For example, confidentiality agreements allow private investment managers to perform detailed analyses of non-public information before making an investment. There's no rush for a private equity firm to sell at one point in time. They're interested in maybe pursuing a sale later on. They may cozy up to one other firm to share information. So people have ability to do a lot more diligence ahead of time. There's the prudent use of leverage. Leverage can help enhance returns of more mature companies with strong unlevered return characteristics. And one big reason is obviously the broader opportunity set. Private funds, the opportunity set for private funds include private companies, public companies, potential non-core divisions of both public and private businesses. Furthermore, a growing universe of private companies is creating an increasing demand for private capital. Since its peak in the mid-1990s, the number of U.S. publicly listed firms has declined by 50%. Today, the opportunity set for private companies is approximately 10 times larger than that of public companies, with the biggest discrepancy being in smaller and mid-sized businesses. And finally, there's the value-add operational expertise. Big pieces of some firms have, well built out senior advisors or operational capabilities. Some are turnaround investors. Some are going into distressed assets, trying to turn them around. But these operational controls can drive substantial improvement in a target company's operation and bottom line. So what are investors looking for today? What are some insights? This is just a word jumble taken from a handful of recent meetings that I've had pretty much globally. What are the most common words that investors around the world are looking for in managers? Given the tumultuous market, it's not surprising that many are focused on investing with GPs that have a long established track record and have an eye towards the downside. Even more so on the institutional investor side, or on the individual investor side, they're looking for consistency, a track record of producing strong returns in any market environment, investing in sectors that don't have broad economic swings or are exposed to large exogenous shocks to the system. They want a safe pair of hands and a manager that kind of knows what they're doing. So all this goes out to a flight to quality. For those that don't have any private equity or pure private equity fund manager exposure, you may have some private investments, but no pure manager exposure. Speaking personally, and from some of the individuals that I've worked with that are starting to build out their private equity portfolio, we believe that it's a good place to start with kind of a middle of the road manager, one that doesn't do a lot of outside of the norm or very super niche opportunity sets where maybe they're very cyclical or they're very affected by broad exogenous shocks. We know that from COVID, many of the managers that invest in the travel and leisure industry or health and wellness in the fitness space, or even in the energy space, there's been broad swings over the last 4+ years since COVID hit. So many want those uncorrelated types of industries. But I'm going to pause there. And Michael, I'm not sure if you have any questions. I can open up for questions, but I can continue talking about how to maybe go about finding a manager or what the best way to approach to doing that.
Yeah, I mean, if anyone has any questions, they can absolutely. Now is a good time to ask, and then as kind of a little halfway point, I guess. I would love to hear more about how you go about finding that manager, though. Like, the process involved with that.
Yep. I'll just pause for 10 seconds in case anyone jumps in. And please, my job is pretty much speaking all day long, and I never like it. So I want this to be an engaging discussion for those that have any question at all.
I can absolutely understand that.
Yep.
Yeah, you're doing a wonderful job, though. I'm
Thank you
enjoying
very
listening
much.
to you talk. So,
Yep. Well, all right. So the way to help find a manager, if you're pretty much starting from scratch, honestly, just kind of do research. You got to look at your own portfolio and set a goal in mind in terms of what you're trying to achieve. If you are nearing retirement age or at the point of maybe accessing your IRA, a VC investment where the higher end of the return spectrum can be very positive in terms of wealth generation aspect. It may not work out. So that may be too of a risky investment. Again, the higher the risk, the higher the reward. So you want to make sure you're balancing on the risk spectrum. But honestly, there are a number of resources in terms of online. If you honestly just Google some of the top middle market private equity firms or large cap private equity firms, there's an easy list there. And from us personally, I mean, at least from my job, the investor relations individual is the person who is going to help service you. And me personally, I want to be a resource. I mentioned in the beginning that one of my goals is trying to expand the access to alternative investments to individuals. I think after this, I think you may have my email, or at least my contact information, or at least Camel Plan will give you my contact information. If you're ever interested in getting in touch with any specific private equity firm and don't know who the right contact is, if you want a benchmarking of give me some private credit investors that are focused on the North America between X and X fund size, I'm here as a resource for you. I'd be happy to pull that information and help send that to you and work with you in terms of helping build that portfolio. Again, I am the resource for you. But to be honest, the way some of our individual investors that I've started from scratch, they invested with us, and through us, they've been asking to help build out their portfolio and have basically just asked, who's another manager that you respect? Or do you know another manager that specializes in healthcare? I would love to get exposure to the healthcare industry. For us, most investor relations professionals, if you're not a nice person or open to helping anyone out, then you're really much in the wrong business. So for us, it's just communication and networking. Never be afraid to reach out in that aspect.
And I can confirm we will send out your contact information, both to the attendees today and also anyone that signed up for the webinar and wasn't able to attend today. They'll get a replay of the webinar and your contact information.
Great. Well, I pretty much sped through. I know that I like to keep things, short and sweet. Obviously, this is available for recording, but that's kind of my pitch in terms of why it's good for an IRA. Honestly, I would think private equity and its 10-year. By the way, the average tenure of a private equity fund is 10 years. For those that have an IRA, you're not planning to access it in the next 10 years or so. This is, in my opinion, a no-brainer in terms of access, trying to build your portfolio through an IRA with alternative investments.
Do you have a lot of people currently that are using their IRAs, their 401ks?
We do. So I would say a smaller than I would think. We have about, I'd say 20 current individual accounts from IRA accounts. I believe that many don't yet know that they are able to invest in private equity funds through their IRA. And so one of my initiatives this year is going out to our current investor base to let them know that they can do this. And obviously, Camel Plan, being a very well-respected and self-directed IRA plan, we'll be partnering with Camel Plan there to help direct people there. But to be honest, I don't think many know or that they can do that. So it's educating the industry in terms of opening that access point. I know I do have an investor that invests out of their personal account. Just they want to do that as well as their IRA. So there are two sources of capital that they can invest behind.
And we do have our first question. Steve Bauer asks, what are typical minimum investments what are typical minimum investments into PE funds?
Very good question. And it is very broad range depending on the size of the manager. Speaking from our side, the minimum commitment for our funds is $100,000. And that reason behind that, our funds are between, we're targeting our fund right now with a $4 billion fund size. So the relative size and scale of, in terms of capital calls and distributions for the percentage of that commitment may be too small to would not make sense anything below that. But for funds of maybe a $200 or $100 million size to $1 billion size, I know that they can accept as small as $20,000, $30,000, $50,000 commitments.
Absolutely.
For large cap players like Blackstone, Carlyle, KKR, I don't believe that unless you're investing through JP Morgan or some type of feeder fund vehicle, I know that they typically don't accept commitments under at least, I know their stated minimums is $5 million. So for us, coming as a family office, I believe that we have an outsized share of individual investors, and that investor base is, in my opinion, very sticky, very pleasing to work with. And obviously for us, it expands the pie of knowledge. So we try and accept as small of a ticket size as we can.
Makes sense. I like the sound of that.
Mm-hmm.
Yeah. So again, if anyone has any questions, feel free to post them in the Q&A. Yeah. And otherwise, was there anything else you wanted to talk about or cover? Or I know you said you finished the presentation, but just in case.
Maybe I'll talk about, I'll end it with maybe some perspectives in terms of the current market today, what private equity is seeing today. It's a very interesting market, to say the least. A lot of the reason in terms of deal volume, the amount of originations that are coming from private equity firms, it's definitely on the slow side right now. Big reason behind that is the state of the current capital markets. It's very hard and expensive to find financing for large deals, especially for the markets that Oak Hill plays in. So managers today, you have to be very creative. You have to be very creative, and you have to really know what you're doing. So many managers are doing some creative types of originations, either recapping a business or starting out smaller, like a de novo platform, and building up from scratch, the buy and build strategy. One big important thing to look into a private equity manager is vintage diversification. And vintage is the year at which one invests. So, when you think about a manager that maybe invests 50% of their fund in one given year, you have 50% exposure to whatever the market is that one given year. And as a good goal to follow is, you want to make sure that you're spreading out your investments over multiple years in order to get access to broad markets. So for us, we're trying to find very creative ways to invest in any type of market environment. So we're doing some stuff that we think is, we wouldn't do in a very bull market, but for today, we want to make sure we're taking advantage of maybe some of the pain that's in the market. Maybe we're buying businesses for a little bit cheaper on the smaller end of the side. M&A has become a very large part of our value creation strategy. So, today May sees returns as compressed, deal flow is not happening. So if you do have a manager in mind, or looking at managers or diligencing managers, a good common question to ask is, how are you been able to source investments in different types of market environments? What's been your success? Have you slowed down in terms of your pacing? What does your pipeline look like? That provides insights both in terms of what their strategy is based behind, but also whether or not they're able to creatively source capital, because it's important to get vintage diversification.
And we do have another question that just came in. The question is, how many individual companies are included in a typical PE fund portfolio?
Very good question. Depending on the manager, some may have, I know for like VC investments, They may have 30 to 50 investments in a fund. For a standard, I'd say, core middle market firm like us, we have somewhere between 11 and 13 investments. For a very large cap name, it may be between 12 and 20, depending on the size of the manager and how their investment strategy. Oak Hill, we try to target a very narrow band of equity holdings where we want to try and have a concentrated portfolio, meaning we don't want to have investments as small as the smallest investment being $50 million and the largest one being $600 million. We want to make sure that we're targeting investments all within a very similar fund size, similar size range, so that no one investment is heavily weighted to the portfolio versus others, and we can't spend time on it versus more. So I'd say an average that in terms of the market that we play in, I see an average is 10 to 15 investments in a portfolio, at least in private equity buyout.
Awesome. Thank you for that answer. And I will just put out there, a final call for questions if anyone has any. And if not, we can head toward wrapping up the conversation, which I've really enjoyed, and it sounds like a lot of our attendees have as well. And as people are filtering out, I'm going to take that as there are no more questions. So once again, I just wanted to remind everyone that if you do have any questions, we will be sending out this full webinar in video form to anyone that was here or was not able to attend. It'll also be on Camoplan's YouTube channel, as well as all of Jacob's information and all of our information as well. Jacob, thank you so much for coming on. It was truly a pleasure to have you.
Thank you very much for having me. And again, for anyone, please do not hesitate to reach out.
All right. Well, like I said, thank you. And we will talk to you soon.
Have a good one.